All right, we are still on chapter 11. We're on the second video. So the next thing we're going to talk about is any additional issues related to cost allocation and partial period depreciation. So some businesses will just sort of set a standard, like if they bought a asset like within the first 6 months of the year, they'll just do it like a half year convention. So kind of an example, they're kind of using the same things that we were using in the previous video, going through the regular way to calculate depreciation, but now we're going to look at it as doing this half year convention. Okay. So the asset still has a cost of 250,000, residual value 40,000, estimated life 5 years, estimated production of 140 units. Look right down here. We still have 150 units. They adjusted that one. That's the only thing they really changed on this one between straight line and double declining balance. They're a little bit different, but they kind of gave us units from the beginning of April all the way to the end of that year. Okay. So they just give it all to us at one time. So let's look at straight line really quick. Okay. So I guess they're not using a half year convention because I see they're using that fraction of 3/4. So that'd be April, May, June, July, August, September, October, November, December. So that's 8 months. So I can see where they did the 3/4. Okay. So they took what we calculated in the previous example, multiplied that times 3/4. Okay. Then that's what depreciation for 2027 will be. Okay. All the way down till 2032, that last year will only grab a fourth of it. Okay. Double declining balance can be just a little bit more complicated because we already have a fraction in there. That 2 divided by 5, remember that's the 40%. Okay. And so on that first year, they're going to multiply it times that 3/4 to get 75,000 is the depreciation. I believe we had 100,000 in the previous one. We ran out because that, remember, this one had a depreciation, I'm sorry, salvage value of a little bit higher. So we only got to do 4 years of that anyway. So remember, when they get down to here, they took, it's the 105 minus the 42,000. And let me calculate that really quick. That is 63,000. Subtract out the 40K gives you the 23,000. Okay. Now, when it comes to units of production, they just told us the units. We really don't have to change a whole lot. Our units changed just a little bit in that year one because it wasn't, notice we did not multiply that times 3/4. Okay. They didn't have a good estimate or they didn't know how many units in that first year. They could have just taken what actually happened and then multiplied it times 3/4. But units of production, they know how many units it is. Okay. So we stagger all the way down to 0 in that last year because remember, the salvage value was quite high on this one, and they estimated 140 units up here. We based our estimate on 140,000, but we actually produced 150. Yay, we like that when we produce more than what we assumed that it would. All right. So if you wanted to do the concept check, you are more than free to pause the video and do that. Let's talk about dispositions. When we get rid of some sort of property, plant, and equipment. Okay, we'll start with the selling price or consideration received. Right now, we're just talking about cash. We do talk a little bit about exchange and like kind exchanges. Okay, then we're going to take the book value. Okay, the original cost minus any accumulated depreciation gives us the book value. Okay, if we get more than the book value, we have a gain. If we get less than the book value, we will have a loss. Okay. So here they are going to give us an example. So same problem we're working with. On December 1st, I'm not going to read all this. This is all the same. Okay. Suppose Hover decides not to hold on to the machine the expected 5 years, but instead sells it on December 31st, 2029, 3 years later, for 140,000. The first thing you will always do on these, and this is where test questions, CPA exam, everything really likes to trip you up on this. You have to catch the depreciation up to date. You've got to bring it up to date. Okay. You can't just ignore that. You have to bring the depreciation up to date. So they're saying this is on December 31st, 2029. We're assuming they have not brought the depreciation up to date. They could have told you after the depreciation, this is what it was, but they didn't. We're actually using information that we calculated in the previous video. Because remember, the whole year's depreciation was 42,000. Okay. So that's the first thing we're going to do right there. Bring the depreciation expense up to date for 2029. Okay. They draw a T account out here for accumulated depreciation. You know, I love T accounts. So we have 2027, 2028, and 2029. That totals to be 126,000. Okay. What is my book value right here? Okay. 250,000 minus 126,000. Again, I did not do that, but it's probably on another slide, but I kind of wanted you to see it. So that means our book value is 124,000. Okay. So there we go. There's our original cost, our accumulated depreciation caught up to date. Okay. That's where you might miss that gain or loss on how much that gain or loss is if you forget to bring that accumulated depreciation up to date. Okay. So we got 140,000 for an asset that has a book value of 124,000. So we have a gain of 16,000 on this sale. Now, I've told you this so many times. Figure out what you need to do on these journal entries first. You know you're getting $140,000 in cash. So you know you're going to debit cash. We have to take the cost off the books, and we have to take the accumulated depreciation off the books. Okay. I'm just going to jump up here by the accumulated depreciation and put, what was this? It was some sort of machine. Okay, we'll just say machine. It has 250K in there. Okay, so we have to make that account 0. So we're going to credit that machine for 250K. This account we have to make 0. So we will debit it for 126,000. Okay. There's 3 of the 4 things that you need on this journal entry. So 3/4 is 75%. That's passing, y'all. Okay. That's all you need when you take the CPA exam. Okay. So I told you to figure out cash, have your equipment, and have your accumulated depreciation. And then your gain. If you did not know it was a gain, if you put those 3 things in there, you need a credit. Oops. If you need a credit, then it's always going to be a gain. If you needed a debit, it will be a loss. Okay. So technically, you didn't really even have to be able to calculate that. Okay. You could have gotten the 3 entries that you knew and then be like, and even if you didn't get it right, again, like I said, that's 3/4, that's 75%. That's passing, y'all. Okay. But you can reason that out. If you needed a credit, it will always be gain. If you need a debit, it will always be a loss. Okay. So now they say, what if now we're going to assume Hover sold the machine for 110,000. This amount is $14,000 less than the book value. Okay. So here we're getting 110,000. That's a big difference between 140 and 110. Notice my book value right here did not change. Okay. I do have a loss because I have a negative number now. I put the proceeds minus the book value. You always want to go that direction. But again, even if you didn't, you know what you have to do over here. Okay. So you know you need the cash, the equipment, and the machine. It is equipment. I put machine up there. And the accumulated depreciation still have to be taken off the books the exact same way. Okay. You're going to debit cash for 110,000. You need a debit to balance. So therefore, you have a loss. Okay. All right. So we've kind of talked about that. I really don't want to make these videos any longer than they need to be. Okay. So let's talk about assets held for sale. They have to be met, they have to meet this criteria. Management commits to a plan to sell the asset, assets available for immediate sale. There is an active plan to locate a buyer. I mean, that could be just listing it with an agent. Okay. The completed sale of the asset is probable and typically expected to occur within 1 year. And the asset is being offered for sale at a reasonable price relative to the current fair market value. Okay. Management's actions indicate the plan is unlikely to change significantly or be withdrawn. Okay. We are going to have to list it on our books at whichever is lower, book value or fair market value. Okay. Whichever one of those is lower, because remember, we're US GAAP accounting. We want things to look very conservative, the worst case scenario. Okay. All right. Let's talk about retirements. Sometimes we don't sell the asset, sometimes we throw it in the trash. Or we take it somewhere and we sell it for salvage scrap metal, or we just might be happy that somebody took it off our hands and we didn't have to do anything else with it. Okay. Um, in this case, it's very similar to a disposition, except you're not getting anything for it. Okay. So your loss, you will have a loss. Your loss will be equal to the remaining book value of the asset. Okay. If the book value is zero, then, if the book value is zero, that means your asset is the exact same as the accumulated depreciation. Just take those both off the books and it's gone. Okay. All right. Another type of depreciation method, we have group depreciation methods and and then composite depreciation method. So group, this will collect depreciable assets that are very similar in service lives and other attributes. Composite could be very dissimilar. Okay, it's just a way to bring up one calculation for depreciation. Okay, so here they give us an example of group depreciation. They say the Express Delivery Company began operations in 2027. It will depreciate its fleet of delivery vehicles using the group method. So the cost of the vehicles purchased early in 2027, along with residual values, estimated lives, and straight line depreciation per year by type of vehicle are as follows. Okay, so we have three assets: van, truck, wagon. Sounds like we're in the 100 plus years ago. We have the residual value of each one of those, and then we get a depreciable base. Okay, here's the estimated life. We're going to divide that depreciable base by that to get a depreciation per year. Okay, that is 52,800. I don't know why some of these numbers did not pop up on your like those numbers. They were just blank. So I had to go, I wanted to make sure I had the right numbers. I did do some calculation on that. So if we take the 52,800 and divide it by 330,000, we will get 16%. Okay. If we want to calculate the average life, we'll take the 272,000 and divide that by 52,800, and that will give us 5.15 years rounded. Okay. So there is the possibility of changes in constitution of asset groups. New assets are added and others are retired and sold. The additions are recorded by increasing the group asset account for the cost of the addition. Depreciation is determined by multiplying that group rate that we calculated by the total cost of assets in the group for that period. Okay. When we get rid of an asset, when we're doing group or composite, there is no gain or loss recorded on those. Okay. The gain or loss just gets shoved back into accumulated depreciation. Okay. So I think they give us an example here. So they said they had a delivery truck that cost 15,000. They sold it for 3,000. Okay. They are going to you get your cash, okay? 3,000. That's how much cash you're going to get. You know the cost of it was 15,000. They're just going to shove $12,000. They're just making the entry balance because they're doing group or composite depreciation and they don't have any gains or losses. That just gets shoved into the accumulated depreciation, okay? There we go. All right, and here is a disclosure that just shows us Union Pacific, how they disclosed all of this information and how they did their group and composite depreciation calculations. Okay, um, quick look at US GAAP versus IFRS. US GAAP, the company reports property, plant, and equipment in the balance sheet at the cost less any accumulated depreciation. Um, GAAP prohibits revaluation, but IFRS actually allows it. It actually allows the company to report property, plant, and equipment at the book value or alternatively at the fair value. Okay. If the company chooses revaluation, all the assets within that class of PP&E must be revalued on a regular basis. So if one of your assets in that whole class, let's just say it's buildings, if one building went up in fair market value and another one went down in fair market value, you have to look at it across every single building that you have to. I feel like that kind of levels the playing field so you don't get to pick and choose. Oh, this building had gained in fair market value, so we'll make that one go up, but the one that decreased in fair value, we're not going to do anything with it. So you have to use it across the different classes. Every asset in that class would have to be revalued. Okay, that is all for this video, and we'll pick up on the next one.